Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of orats, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Trader brokerage account. Today on the show, we're going to learn more about Matt's portfolio and his strategies for options trading. Matt, do you want to share your screen and get us started by going over our positions from last week?
Sure. All right. So last week, you see my screen okay?
I do.
Okay, good. Last week, what do we have? The SPX, we were still riding the put, didn't do very well because the market went up. And we got long via I believe it was the IWM short put spread. It's about break even. And what else did we do here? My short call spread in XSP went against us a little bit, so slightly down. I thought we had one more trade. I forgot to take a screenshot of it, Tyler. So I think that was it on the ones that I had. So CSC, we're still around 113,000. NVIDIA is still doing pretty good for the team. But that's about it on the trades, Tyler.
Thanks, Matt. I can't see your camera moving. It looks like you're frozen in there, but we can still hear you.
Okay.
But yeah, let's talk about today. So we got a question from one of our users asking about Matt's portfolio structure and some of his strategies for trading. So none of this is investment advice, but we are going to take a closer look at Matt's portfolio, and I'm just going to ask you some questions on how you structure it and some of your options trading insights. How does that sound?
Yeah, it sounds good. I'll start, Tyler. I follow. Actually, my dad told me about this many years ago. The Permanent Portfolio by Harry Brown, I believe, and it's a philosophy where you're 25% in stocks, 25% in bonds, 25% in gold, and 25% in cash. And Harry showed that he wrote a book in the 70s or something that was overall for a very long term, that is the best performing, least risk strategy, performance over risk. And people have looked at it and updated it, and you could actually buy, and I have some of the Permanent Portfolio ETF in there. And then what I like to do is put an additional layer of risk mitigation on that strategy is using options. I actually use cryptocurrency too, but we won't get into that. For the cash, 25% cash, I use up to 15% Bitcoin. But again, we could talk about that later. We'll just talk about just the tradable assets, let's say, that have puts on it. So one of the things that you can do is treat that strategy as you could buy ETFs. Suppose you could even buy indexes as well. I mean, index protection. You can't buy the actual index, but so we'd use SPY for the S&P. We'd use TLT for the long-term bond, and we'd use gold, GLD, are very liquid ETFs. So, and one of the things that you could do is you could go back and use our backtester and create these strategies in there. So you could go create new backtest. You could say SPY, you could say bull strategy, and you could say long stock and run that. And then what you could do is then combine them with a short put, because we're going to be combining, sorry, not a short put, but a long put and a short call. So run all these separately and then combine them all together. And what you could do is you could compare the combination of just the stocks together, they're just the ETFs together, and then compare them with just the puts or just the calls, right, and with all the calls and puts. That makes sense so far, Tyler?
Yeah.
Okay, good. So I did that recently before the show. And so, again, I ran the S&P long stock, TLT long stock, gold long stock. And then if you click them all, you could then combine those. And I like to combine them in one weights of 100%. So just 1, 1, 1, and send that off. And I've already done that. And then you could go get all of them and then do the same thing. And I've done that as well. So let's look at, so here are them all together. So basically it's additive. So it's basically 24%. Yeah. So 11.7. So it's almost 12 plus 9, 21 and 3, 24 point something. So that's how you get that amount. So that doesn't do anything other than just add those all together. So it's not quite what you would do, a third, but for purposes, it's just the easiest way to run this using our combine feature here. So then what you do is so that's 24%. Then I did the long puts and short calls all in one. So 9 total strategies here, and then added those up. So I ran, let's just look at them individually first. So the SPY long put, as you would imagine, has slight drag to it. In this case, I like to do a long-term put out of the money. So you get a little blip here and there. There are some probably other ones that you might use that I actually do a short-term, medium-term, and long-term, just so it evens out the blips for no better way of saying it, but when you actually make money on the puts. And then and actually I could show you here in this particular case, I monetize it, or if it has a profit of 200%, I trade it out of those. And then every 30 days I put a new one in. So we have probably 12 going at each time. So this is a pretty good way to look at a put that you might do against this. Again, I would probably have a 90-day and a 45-day, and then all of those adding up to the number of shares that you have. So far, so good, Tyler?
Yeah. So is this a like a strategy that you're putting on, or just a demonstration of some ideas?
So this is more of a demonstration. I'm not going to do the exact strategies that I'm doing because it gets a little bit needlessly complex, but this is how, in general, you would structure it for yourself. So we're not giving the exact trades to do.
Got it. Okay. Yeah, we were asked, what are your thoughts on systematic trading versus discretionary trading, and how do you balance that in your portfolio?
So I'm going to assume that has to do with this particular strategy, and then for the first part, and then I'll answer it if it's not for this particular strategy for the second part. Yeah. So for this strategy, it's so long-term that, and when you set your monetization factors in the test, it's basically to test it against it. My monetization, the way I monetize is when I'm up, 200%, I will sell 20% right away, depending on what I think the market's doing. And then I'll sell 40%. So that's 60 so far. And then another 20, and then I'd probably hold another 20. So it's difficult to backtest that strategy, but that's what when I backed market makers, that's what I'd always tell them. Like, if we had a good profit in something, take immediate profit, small amount. So if it goes back, at least you have some, and then take what is the lion's share. So now you have 60 down, and then you work with that remaining 40. So I would say probably not systematic on this, because you should be able to do this one quite readily. Where you could almost have this where you're trading maybe 4 times a year. So I think that's doable. Anyway, so that's the short put, or that's the long put. I also have a short call, actually profitable. Let's take a look at that. And then we have in orats, let's make it a little bit bigger. We've had some complaints about my numbers being too small. So this is a short call. For a long time, the short call was not profitable, but now it looks actually pretty good. So it's not a drag on the portfolio. So you actually get a little bit from that. So what I'd like to get in now, so when we combine all those together, you might say, well, that looks like a drag of 1% and 1.4%. It is, but also you've increased your Sharpe. So that means that the annual return divided by the volatility of the investment. So the volatility of the investment has gone down. So that's why the Sharpe is higher in this case. So that's a good result. And then I did it where you're only buying puts with it, and that actually was not as good, neither from a Sharpe nor from an annual return perspective. So any questions so far on that, Tyler?
Well, yeah, I mean, that makes sense. I'm curious to see the max drawdown in those two and kind of comparing that. See if there's a difference in, I mean, you can see the number there for the Sharpe, but I'm curious, like, what's the worst annual return? What's the worst monthly return in these strategies?
Right. So on this particular strategy, this is one of, again, I have tranches of puts. This is probably the put that weighed least heavily against your return. So these puts are only losing, less than 1%, between the 0.5 and 0.75%. So those are pretty far out of the money. So they're not going to protect you too much. Like, they're going to protect a little bit, but not a whole lot. So let's take a look at it. So if you had this position on, and first of all, the theory behind the strategy is that your drawdown should be less than, holding these all together, it should be less than just each one in particular. So in this case, your drawdown, and I think it's helpful to look at drawdown in relation to how much you make. So what is that? 1.5 times of your annual return. So that's how long it takes you to get. That's how long it took you to get it back, which is about what the computation that I just did just there. You might expect 1.5 years or something. So that's 38% drawdown for just the stocks altogether. And if you look at the short call, long put, the drawdown for the short call, long put is 32. So it's about 6% less, with only, again, spending 1%. So I would say that, for me, that's okay. I'd like to cut this down more. And the way that you would cut that down more is then you would say, well, let's look at this long put and let's go from, a 7 delta. You could even do a 20 delta, and let's see how that looks. So there goes SPY. And so next will be TLT. And finally, gold. And what we could also do, that's not what I wanted to do. What we could also do, Tyler, is go look at the backtest finder real quick and take a look at what the backtest finder finds in these. So the best long put would be there, and then if you put, you need to be in the market 98. Oops, that's not going to find anything. 98% of the time. We'll see which long puts do the best there. So this is in the market the most. So this is just kind of looking at the returns. 333. Oh, stop loss of 300%. That's interesting. So this might be something you look at a 30 delta with a stop loss. I haven't seen that come up that high before. Let's take a quick look at that, make sure it's real. So you made a ton. So, I mean, that if you want protection, obviously, but you're going to be, you're going to be losing 10%, 13% a year, which is probably too much for people. So
yeah,
I wouldn't really do that, even though it's coming up as a good overall test.
Yeah, I wonder if there's a way you can filter those big swings out of this backtest finder.
Well, that's what you want to see. You want to see it doing really well, but what you don't want to see, and I think what you might be saying is you want to filter out these annual returns during bull markets. You can't have 895. So you might say, the most I want to lose is maybe 4% or something.
Yeah, that's a good filter for that. I think a lot of people could find a lot of good protective puts here if they use this filter.
Right. So this is a little bit more reasonable, but again, we should also do this. This is why this is such a great tool. In bear markets, you probably want more than 5%. Like I would want, at least 8%, right?
Yeah.
So, and this bear market is really cool. So it looks at the financial crisis, it looks at Volmageddon, and it looks at the bear market of 2018, end of 2018, and COVID. So it's really cool to be able to do that. So now we're getting to a point. Well, this is almost what we're running right now. But they're taking 300%. So this is why it's such a great tool. You can set your percentages. They're also setting only get into these during these times, and even then it's in the market for almost all the time, but it's only getting in at these entry triggers. Does that make sense, Tyler?
Yeah.
So it's not just blindly getting in; it's only getting in when the spread to the stock, the amount is at a certain level. So that's pretty cool. So yeah, I mean, obviously this would have protected you a lot better if you could look at the monthly returns, and it didn't it wasn't terrible in the other months, but it's still 5%. Quite a bit. But you're also getting 23% of protection. So it'd be nice to have maybe 1/3 of your portfolio into this type thing, like a 20 delta. And then, because that's going to give you a lot of protection there.
Great.
And COVID. Yeah, so that's really cool. I love using this backtest finder and also the custom backtester. So you could see that, -1%, -2%. It was interesting that so let's do this, Tyler. Since, we're not seeing, this is only at not even 1% loss because they made so much more because they they monetize at the right place. That's why they are doing better than we did, and they have these other rules. But that's a little bit difficult to do. So now, if you were to add these puts and the calls and the stock together, let's see how that looks. So combine. And then this is kind of a manual process, but you have to go one tab, one tab, one tab. All right, then we can submit that. So basically what this does is combines all of these daily returns into one backtest.
Yeah, really neat that you can do that combination.
Yeah. No, it's great. I spent way too much time on this, and then you could also, in addition to using the Finder, I've used other types of puts here, where let's just take a look at this. So this is this is one that's more reasonable, I think, but it still gets you 13%. The worst year is 3.9, but that was if you kind of ignored 2009 since the vol came down so much, it's about 2.5%, something around those, and then you get 10%, every one of these crashes. So and it even made a little bit in 2018 for being that far out. When did this? It exits at a 60 delta. That's interesting. Not a profit. So it starts at 16 and it'll get out when it's a 60 delta, not a profit target. Which again, this might be another one to have in your quiver of puts. I don't like to have all of my puts in one strategy. I like to have different strategies and different timing or staggered of strategies, just so that it's not too path dependent, if that makes sense. Something rallies and then you're kind of out of some of these. So that's an interesting put as well.
Great. Yeah, thanks, Matt. That was pretty insightful. I really like the Finder and what you're doing here with the combinations.
So let's just look at this real quick. So now with a more in the money put, you have your sharps a little better, not quite up to the other one, and you lose a fair amount, 5% a year. But let's look at we went from almost 39, I think, percent drawdown, and then we got it down to 32, and now we're at 27. So the drawdown at 27, again, you need to figure out what you're comfortable with there, but it seems like we're getting more towards a comfortable number at that point. And especially these sharps and sortinos that sortino is pretty good.
Yeah, it's all about what you're comfortable with, right?
Yep. Sortino, I should explain, measures just downside volatility, not upside volatility. So it only takes a volatility reading if the market is down slightly, or not slightly, is down at all.
Mm-hmm.
Yeah. So that's in general, that's the type of portfolio that I put on that I could sleep well with. And you're going to give up some percentage, but you have those puts out there, which is nice. Especially, I'm a little bearish on the market, as you may or may not know, but there's a lot of signals out there, and not so many volatility signals, but copper to gold ratios. I think this season's retail sales are terrible, and it often happens at the beginning of a presidential term, like 2008, 2000 is when you kind of get some volatility to the downside. So this might be a thing to consider, Tyler.
Yeah, that's an interesting observation there. I wonder if that's something we could backtest or create a signal for one day.
Yep.
All right. Well, thank you, Matt. If you guys have any questions, we're happy to answer them on the show. Just email us at support@orats.com, or you can leave a comment in the video description, the comment section. So we're happy to answer them. All of today's show was from questions from another user, so it's great to see that. We'll be back next week with another show. Thank you, Matt, for this week, and thank you, Tradier, for hosting, and we'll see you guys again soon.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.